Recipes for technical trading success in Cook's Kitchen.
Have you stayed out of the FANG stocks because it's just been another investment fad? Well, I'm here to correct that notion because these are not fad companies. These are franchise investments. And after this 10-minute video, hopefully I'll convince you. I've been telling investors for years to buy several of the FANG stocks. FANG stands, of course, for Facebook, Amazon, Netflix, and Google, although I'm going to make a couple of modifications. So let's go back 2 years to a pretty important report I wrote that I titled Big Economic Disruption, Big Data, AI, and Robotics. And I was pivoting off some early 2016 research about the impact of automation. It was done by Citibank and Oxford Martin School. And one thing that really jumped out to me was this stat I have in yellow. China and India job automation risks are as high as 77% for China and 69% for India over the next 2 decades. Basically, what this went against everything that I believed about the great emerging markets of China and India, with arguably 2 billion people trying to climb into the middle class, that their industrial revolutions could be over sooner than we thought because of automation. And I wasn't going to pick little robotics companies. I said, hey, just buy Amazon, Google, Microsoft, and IBM. And that was in June of 2016. You could have bought Amazon and Google under $750 each. Microsoft was trading under 70. IBM has gone nowhere. But, and I'll correct that one in a minute too. But the main idea was, if you're going to capitalize on these trends in automation, big data, and artificial intelligence, you must own Amazon, Google, and Microsoft at least, and probably IBM. All right. Moving along here. Then, in May of 2017, I did a podcast, What to Do Before the Machines Take Over. And I was pivoting off of this book by the historian Yuval Noah Harari, who wrote Sapiens, which is about our prehistory and evolution. Then he wrote Homo Deus, which is a brief history of tomorrow. And Harari's theme was, just based on the way he looked at history and where technology trends were going, that things like artificial intelligence and genetic engineering were about to drastically change life on Earth as we know it in the next 100 years. To the point where he said, hey, listen, the super rich are going to be able to afford all sorts of biological and neurological enhancements. And they would essentially create a super race of humans. And the rest of us, without any work, because everything's automated, would just be their day slaves. All right, so that's a pretty dark dystopia. But we don't know what the next 100 years are going to look like. And so I continue to say, this is why you buy the companies that are mastering automation. And there you can see I added, NVIDIA got added to the list. I was a buyer of NVIDIA in late 2016, missed the early good buys under $100, but NVIDIA was my replacement for IBM. They're both partners. And actually, I put NVIDIA in my FANG stocks, tossing out Netflix, which was a mistake. It's up, 100% since then. But Netflix is obviously a killer franchise in of itself, but not the same type of technology business that is the main theme that I'm talking about here. So let's stick with that theme. In December of 2017, I wrote a special report for Zacks Confidential called The Technology Supercycle. And I was trying to answer the question, why is productivity so low, and yet we're seeing incredible efficiency in companies like Amazon, Google, Microsoft, NVIDIA, creating massive productivity? And so I was trying to solve the two puzzles of innovation, namely, where's the productivity and why is inflation so low? Okay, and I used 2 economists to answer that question. First, the productivity one, I relied on Brian Westbury of First Trust, who said, listen, the government productivity numbers are weighted to the government because they're 40% of the numerator. So you're not seeing the real productivity in industries, certain retail industries, energy from fracking, biotechnology, just technology in general because of semiconductors. Those areas are growing productivity at 5 to 10%. But you don't see it in the official stats. Okay, and the second thing, inflation. What's the inflation puzzle? I relied on the economist from Vanguard, Joe Davis, who wrote a piece, he titled his article, "The Federal Reserve and Moore's Law." And he was showing how, hey, the Fed's looking for inflation, they're keeping interest rates low, and there is none. Why? Because we're in this long-term secular trend of technology making everything more efficient. Obviously citing Moore's Law, the idea that, you know, we've seen it for 3-4 decades, that every 18 months chip sizes could shrink by half and double in computing power. That sort of leveled off in this decade, but NVIDIA has like reignited Moore's Law because of what they're doing with massively parallel processing. All right, if you want a copy of that report from December of 2017, the technology supercycle, it was in Zacks Confidential. Just email ultimate@zacks.com and request the report, and somebody will get back to you. All right, moving along here. Who's afraid to buy Amazon? Let's look at this one-year chart of Amazon. I was thinking about buying it under $1,000 last October before they reported. What a mistake to only think about that. You know, I blinked, and look, you can see, you know, down there in late October, early November, the stock gaps up after that report, and it's just been just a freight train higher since then. What I did do right, though, in November is I told investors, listen, hey, we just missed the chance to buy Amazon under $1,000, trading $1,100, $1,200. I said, right now, do not miss this train. Go out to June of 2018, buy the calls, buy the 1,200 calls for $70, $70 per option. It's like getting Amazon for $70 a share. Those calls exploded, as you can see. Look back to the chart. If you'd bought them, you had 7-8 months of life in them, and they went out. Oh, let's see, in June at expiration, Amazon was trading, let's say $1,700. So those calls were easily worth $500, at least $400. You made 5 times your money at any point you wanted to in that chart. All right. New York Times a couple weeks ago, they wanted to answer the productivity puzzle, and they found some different economists to answer it. Let me just show you a slice of what they were looking at. So the title of their article, "The Problem with Innovation. The Biggest Companies Are Hogging All the Gains." Let me just explain something here. So they open it saying that economists have been scratching their head about this missing productivity, and why aren't the gains spreading out to more companies throughout the economy? A process that economists for centuries probably have called diffusion. New technology spreads throughout the economy. Everyone becomes more efficient, has more leverage. So I just want to read this one sentence. "Today there is mounting evidence this engine of growth, diffusion, seems to be misfiring, a phenomenon some economists say helps explain the slowdown in productivity growth bedeviling developed economies." And so, of course, we could target Amazon and Google as hogging all the gains, but this is the nature of a real economy. If economists have certain rules about how an economy should work and have some sort of equilibrium and balance and order and stasis, that's not really how things work. I mean, new technologies are by their nature disruptive. Last week when I talked about the cult of stock picking, I reminded investors of 2 important concepts to always keep in mind. Creative destruction, which comes from the economist Joseph Schumpeter, that, hey, this is what innovation and technology do, and punctuated equilibrium, that you can have periods of stability and order and equilibrium, but there will be shocks and industries change and entire career fields change. All right, moving on here. What about Facebook? #2 digital ad platform, but so much more. People who think that Facebook is just this digital advertising platform, I mean, people think of it as, okay, it's social media. But how do they make their money? They make it selling ads. Okay, so they've got, they're a media company. We can call them that maybe. But really, underneath, they're a technology company. I'm showing a picture here of Regina Dugan. She was a director of DARPA DARPA is the Defense Department's Advanced Research Projects Initiative. So here she's a rocket scientist. She actually went to go work for Google back in, I don't know, 2015 maybe, and at their advanced technology and projects secret lab. You know, and Google has many secret labs, and their skunk works. Well, Regina got poached from Google by Facebook, and she went and worked for Facebook for about 18 months. From late 2016, she left there earlier this year, 2018, but she was working in what they call their Building 8, which is their secret lab. So you know that, I mean, we knew this. We've known this for a couple of years, that Facebook is, you know, why do they buy Oculus Rift? They want to be on the forefront of advanced technological change as it impacts cultures, economies, and societies. You know, they're definitely not messing around. All right, so I hope I gave you the credible investment rationale for owning FANG stocks like Facebook, Amazon, NVIDIA, Google, Microsoft. Throw Apple and Microsoft in there too. And these are long-term trends. When I wrote that report, Technology Supercycle, actually when I wrote the first report I showed you from June of 2016, big economic disruption, some people told me, you know, that could be one of the most important investment reports they read all year, because it gave them a 10 or 20-year view of how technology was going to change society and economics. All right, thanks for joining me in the kitchen.